Hi, this is Konhar again. Today's topic, why especially the edible commodities determine the direction of interest rates. Recently, I received a question asking about my opinion on their borrowing costs, if they should go for a fixed rate or a float rate. We somehow know that there is inflation, but not exactly sure how long this will last or how bad it will get. Because higher inflation leads to higher interest rate. While I cannot quite advise them as I do not have a banking license to do so, however, I can point them to the commodity markets, and I hope by doing that, it can help them to understand and read into the direction of interest rate with greater clarity. And for today's content, three parts here. The first part, I'm going to explain to you why, especially the edible commodities, determine the direction of the interest rate. And after that, we're going to go through some technical study to support the idea on the first. And the last part, we're going to talk about how to hedge or to buy or to trade them. Now, before that, let's go to the disclaimer. And please take some time to read the disclaimer stated here or below the description. Now, let's get started on the first part about why edible commodities determine the direction of interest rate. And we have to understand that for this example, I'm using the rice market, and rice is a staple in our diets of more than half of the world's population, especially in Latin America, Asia, and Middle East. The annual production of a milled rice top about 480 million metric tons, and which make this the third most produced grain in the world after corn and wheat. So after this session, you can take a look at the corn and wheat to see if there's similarity. And of course, that will be a topic for another day for the corn and wheat. Now let's go back to the rice. And an increase in rice prices or edible commodities, I believe that it will really add a lot of pressure to the existing global inflation pressure that all of us are experiencing over the world today. So therefore, hardship, it will be more intense, especially compared to those commodities like crude oil. So in short, people can live with some inconvenience without a car, but not without food. So therefore, when food prices become much more expensive, the central bank immediate and urgent measures is to counter it with rising interest rates. Now let's go to the second part to support the idea on the first, which is the technical studies to see if technically that for this market, rice market, it is rising, is creeping up, and what is the future for the rice market or the edible commodities. Now, on the technical, if you've been following over my last few videos, over the last few weeks, in fact, the last few months, I talk a lot, I share a lot about how to draw trend line. And in this case, obviously, the rice market is uptrend. And there are two rules in drawing the uptrend. The first rule is that we have to find at least three significant trough. In the uptrend, we have to find at least three significant trough. And then the next one is to find the best fit. And this is what we're going to do. And how to identify the three significant trough. And visually, we could see that there's one trough here, two trough here, and three trough here. And whether it qualified the first rule, we got to check it out. So we have to start from somewhere. And I'm going to start from here. Let's try this. At least three trough. Then after that, we're going to find the best fit. And this is what I'm going to do here. Just going to move around. And I think that's it. Yep. I'm quite happy with this. Let me explain why. Now, we have the first trough, which is exactly the bottom. And it kind of didn't fall in the neckline or the bottom, so I will ignore this. But for this guy here, it fall at the closing price. This guy here falls at the opening price. And then this guy here, it falls at the low. And we have at least four significant trough. One, two, three, four. Or you can consider this as two and three as well. So this is what I call the primary uptrend line. And now we're going to try applying the same two rules to construct the secondary uptrend line. And later I explain to you what are their usage. Now, so same thing. The first rule is that we have to try to find at least three significant bottom, and we got to start from somewhere. And I'm going to maybe use this, and I'm going to make some adjustment here. Maybe instead of this, I try to find at least three. It got to be almost a perfect fit here. And I'm going to use this line instead. And this became my secondary uptrend line. We could see that it fit very nicely at the bottom. One, two, three. So at least three significant trough. And I'm going to use this as the secondary uptrend line. And this what I'm going to use here is that we could see that over this whole period, it is about 2 years by now. 2 years. Yep. September. So about 2 years. And we could see that it fit very nicely on this primary uptrend line. And then now the secondary uptrend line. That this is what we are going to do here on the secondary uptrend line. It means that maybe you're more towards a shorter term trader that were trading into the position, and it just reacted nicely on this secondary trend line. This is what I'm going to do on any purchase. I hope that the market will go up. But in the event that the market start to close below this secondary trend line, but my expectation for the whole rise market is still up. And the next buy on dips I'm looking forward to will be this primary uptrend line. But this dip may not come. It may just from here, it continue to move up for the rise market. Now I'm going to show you something very interesting here is the yearly chart. We're going to discover about where is the major resistance for the rise market. Now, yearly chart, which is 12 month, and I'm going to spread this out a little bit here. And this is what we are seeing here. And I'm going to include a support line. Yeah, this support line. And I'm going to rest this here. You could see that it's so beautiful. And this is yearly chart. And we can see over the history of since 2000, where the whole market actually started. Yeah, in this contract actually started. Then we could literally see that what happened to 2007 and 8, it was the financial crisis, the Lehman crisis, subprime crisis. And at one period, the market went above about $15.30. But after that, very quickly, it settled below. And we could see the behavior science behind the prices is that $15.30 is the benchmark. And seems like the market do not wish that the rise prices go above anywhere $15. Yeah, so this is how the price behavior is speaking to me. So as we see that along the time frame, and there was this year on 2011, it did try to attempt, but it still closed below $15.30. And we have this period in the year 2000, that's where COVID-19 crisis, it also went up very briefly all the way up, and it closed way below $15.30. And what about this year in 2022? Of course, the year have not settled in yet, or rather. So what I'm saying here is that at the close of 2022 is an important year. And if it closed convincingly above $15.30, I would say that in years ahead, I'm saying that in years ahead, based on this yearly chart, never before that perhaps is setting a trend that the rise market is going to have a continuously moving uptrend. And that's what I'm seeing here. And let me just go back to the weekly chart to give you another perspective. Now, so of course, the other question relating to borrowing costs, whether it's fixed or float, and how to hedge the market, is that one way how to hedge the market is that maybe perhaps if you want to hedge the market, you can buy into resource or commodity unit trust or ETF, that kind of sort, that market. But if you're looking into maybe I can trade some interest in you in rice, in wheat, or other related edible commodities. And let me just take example on this rice commodities here. So how can you trade the rice commodity? Is that first you can go to one of the exchange. You can trade off the rice commodities if you are outright, especially if you are traders. So the contract spec states that it moved by minimum half a cent. Half a cent is 10 US dollars. So I take the liberty to convert it to 1 cent for easier reference. So 1 cent is equal to 20 US dollars. So if as of now, the price is about $18, so $18, I convert it to cents, so it's about 1,800 times 20 is equal to 36,000 US dollars. So what I'm trying to do here is that at least I have to know if I'm going to trade in one contract, what is my total risk? And the total risk I'm carrying is 36,000 US dollars. And that's something that I have to know. So, and say for example, if I enter into at $18, if I take a partial profit at $19 for that one contract of the partial profit, what is my take home? What is my profit? And that is 2,000 US dollars. So similarly, of course, if you short at $18 and if you cut loss at 19, and then that's your risk is at 2,000 US dollars. Continue to explore this topic with these related videos and register for these webinars as well. Follow my Facebook page for my daily market insights. To be updated with my latest video, subscribe to my channel and remember to turn on the notification bell. See you again very, very, very soon.